Ratio analysis transforms accounting data into meaningful relationships that help analysts compare companies across industries and over time. Ratios provide insight into how effectively management uses resources, controls costs, and finances operations. Because individual financial statement figures often lack context, ratios improve interpretation by linking related accounting information. Analysts, investors, creditors, and regulators rely on ratio analysis to identify strengths, weaknesses, and potential risks affecting corporate performance. Effective use of financial ratios supports investment decisions, credit evaluations, valuation analysis, and assessments of long-term business sustainability within competitive financial markets. Liquidity ratios measure a company's ability to meet short-term obligations using current assets. Common liquidity measures include the current ratio, quick ratio, and cash ratio. The current ratio compares current assets with current liabilities and provides a general assessment of short-term financial strength. The quick ratio excludes less liquid inventory from current assets, offering a more conservative measure of liquidity. The cash ratio focuses solely on cash and cash equivalents relative to current liabilities. The program emphasizes that liquidity analysis is important because companies with weak short-term liquidity may struggle to meet obligations during economic stress. Analysts compare liquidity ratios against industry averages and historical trends because appropriate liquidity levels differ significantly across business sectors. Activity ratios evaluate how efficiently a company manages assets and operational resources. Inventory turnover measures how quickly inventory is sold and replaced, while receivables turnover assesses the efficiency of collecting customer payments. Payables turnover evaluates how quickly a company pays suppliers, and total asset turnover measures revenue generated relative to total assets. Efficient asset utilization generally improves profitability and cash flow generation. The program explains that declining turnover ratios may indicate operational inefficiencies, slowing demand, or poor working capital management. Analysts carefully interpret activity ratios within industry contexts because business models strongly influence operational patterns. Comparing turnover measures over time helps identify emerging operational strengths or weaknesses affecting future financial performance. Working capital management is closely connected to liquidity and activity ratio analysis. Working capital represents the difference between current assets and current liabilities and reflects the company's short-term operating flexibility. Analysts examine trends in receivables, inventory, and payables to evaluate how effectively management controls cash conversion cycles. Rising receivables relative to sales may signal slower collections or aggressive revenue recognition, while excessive inventory growth may indicate weakening demand or inefficient production planning. Strong working capital management improves liquidity, supports operational stability, and reduces financing needs. Analysts integrate working capital analysis with broader liquidity and activity measures to determine whether short-term operational performance is sustainable and supported by efficient resource management practices. Profitability ratios provide insight into a company's ability to generate earnings relative to sales, assets, or shareholder investment. Important measures include gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. Gross margin evaluates the relationship between revenue and production costs, while operating margin measures operating efficiency before financing and taxes. Return on assets and return on equity assess how effectively management uses resources and shareholder capital to generate profits. The program emphasizes that profitability analysis helps evaluate competitive position, pricing power, cost control, and operational effectiveness. Analysts compare profitability ratios across companies and historical periods to identify sustainable earnings trends and long-term value creation potential. Although financial ratios provide valuable analytical insight, they also have limitations that analysts must recognize. Differences in accounting standards, inventory valuation methods, depreciation policies, and business models may reduce comparability between firms. Ratios based on historical financial statements may also fail to capture future strategic developments or changing market conditions. The program notes that ratio analysis should be combined with qualitative assessment of industry trends, competitive strategy, management quality, and economic conditions. Analysts must interpret ratios carefully within broader business contexts rather than relying solely on mechanical benchmarks. A strong understanding of financial ratios enables finance professionals to assess corporate performance more accurately, identify emerging risks, and make better investment, lending, and valuation decisions.